Hello, 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 and happy Friday. Welcome back to yet another live event where we unpack multifamily underwriting and passive investing one step at a time. Benchmarking for family offices and measuring what actually matters is the topic I would like to briefly cover today. And it's really based on my observations from two very insightful pieces of content I came across. One is an article from Mr. Family Office, and the other one is a broadcast from S&P's Global Market Intelligence. But before we dive in, for those who may be tuning in for the first time and perhaps have not met me, my name is Vessi Kapulian, former commercial lender turned real estate investor, entrepreneur, and advisor. So today I work with family offices and their family enterprises, advising on governance structures, building the family constitution, next gen transitions, and at the enterprise level, I typically get involved as a board advisor, board director, and bring in the unique credit and risk management angle. I also help investors, whether that's private investors, family offices, perform due diligence on deals. Apartment is my edge and what I focus on, but happy to lean into my prior commercial lending experience, looking at other types of deals, and of course, those willing to do a deeper dive into underwriting. I have a community of investors whom I help review deals as a lender and from a loan committee perspective so they can protect their capital when making those investments. And along those lines, not too long ago, I published a book called Mastering Multifamily Underwriting. You can actually purchase it on Amazon in digital print and audio format, and it helps you do exactly that, learn how to vet apartment deals with confidence and ease. If investing in yourself and learning underwriting is within your new year resolutions. But let's just dive in because I have a few key points that I would like to cover with you. And I really want to start with one simple line that many of you may have heard before: you cannot manage what you do not measure. And in the family office world, that line is especially important and often overlooked. Family offices pride themselves on being long term, patient, and constrained by quarterly pressure, having that long term outlook, and that's a strength. But long term horizons on occasion may also blur accountability, and without clear benchmarks, inefficiencies, underperformance, and governance drift can start hiding right in plain sight. And so, like I mentioned at the very beginning, much of what I will share with you today are my key observations from two very insightful content, thought leadership pieces of content that I came across. One is the article published by Mr. Family Office, and then the second one is a broadcast by S&P Global Market Intelligence. And both of them have done very important work, really shining light on benchmarking in the private market space, which family offices typically fall within. So a few key points that stood out for me. And by the way, if you'd like a link to the article or the broadcast, simply let me know. I'll happily DM those to you so you can explore the full content and not only my own observations. But one of the key insights for me was that benchmarking is really a diagnostic and not something to be used as a competitive measure. Of course, if you're part of a financial institution or if you are a financial institution, you're typically judged against peers and indices. But family offices are different. You're managing your own capital for your own objectives, and so success is not just about beating an index or showing up in the top leagues and top performer public tables. Oftentimes those decisions are actually quite private. But that is not to say that benchmarking does not matter. It actually still does, because you're not chasing rankings, but really you're looking at how uh, diagnose to diagnose how well the family office and portfolio is functioning. So the real purpose of benchmarking is to surface blind spots, misalignment, structural weaknesses, risks that perhaps have not yet shown up. And many families believe they know how they're performing compared to peers, but in reality, uh, that view is often built on anecdotes, conversations, maybe selective and qualitative data points. So, true benchmarking really replaces those assumptions with evidence. And it reminds me of the quote that I opened up this conversation with, and that's attributed to Peter Drucker, who said that what gets measured gets managed. And in family offices, I would add even one more element to this sentence. What does not get measured eventually gets felt emotionally or financially. So the second insight for me in reading those two thought leadership pieces is that financial benchmarking must be aligned with the type of risk taken, and financial benchmarking is where most family offices typically start and where many also stop. So, at the high level, the question could be naively simple: is the portfolio meeting its objectives? And for most families, that means preserving the purchasing power, generating real returns over time. That also often translates to benchmarking against inflation, plus perhaps a certain margin, cash or risk free rate, strategy appropriate alternatives. But here is the key point: benchmarks that do not reflect the actual risk profile are irrelevant. A private equity heavy portfolio, for example, should not be judged against public equity indices, or a conservative liquidity focused mandate should not be compared to an aggressive endowment style model. So, the more appropriate question to ask and the more sophisticated approach to take is to benchmark by asset class, assess the risk adjusted returns, analyze performance in those stress markets, and separate the repeatable process from just pure guesses or luck, even when it comes to performance. And it's this is especially more difficult in the private market space. I As highlighted in the very detailed discussion within the S&P Global Market Intelligence broadcast, private investment is opaque, long dated, and uneven across different vintages and strategies. So without structure, performance reviews in private assets can become also somewhat emotional or even political. So the best offices show discipline in those conversations by benchmarking each sleeve independently and reviewing results on a regular basis, not just when there is a big twist in the market. The third insight for me really pertains to the cost capability and the right operating model. Sometimes I feel that cost benchmarking may be misunderstood. According to the Mr. Family Office article, many family offices operate with expense ratios of 50 to 100 basis points, depending on the asset size and complexity of the portfolio and staffing level, with specifically staffing costs being the largest driver of those expenses. But with median headcount being typically under 10, though again, complexity varies widely. So from that perspective, benchmarking that is not about being cheap, right, or being under that 50 to 100 basis point threshold, but it's really about alignment. So, uh, as he was mentioning, a lean office running complex direct investments may be under resourced and actually exposed to key man risk, right, if they're trying to align themselves with that type of index, or a higher cost office with really strong controls, experienced talent, robust reporting may deliver a far better long term value in that example. So, the real question about benchmarking then becomes, does our cost base actually match our ambition, our business plan, what we're looking to accomplish here? And this is where the benchmarking becomes strategic and not cosmetic. Insight number four for me pertain to liquidity, and that's I call the new benchmark of resilience. Especially in recent years, one of the most important shifts has been around liquidity benchmarking, and more family offices, high net worth individuals are now stress testing their portfolios, the cash flow. They're modeling prolonged downturns, asking whether the portfolio can fund the family needs across generations and not just during benign markets or shorter cycles. And so, liquidity benchmarking in that sense is not only about just cash on hand or cash sitting idle, but about where liquidity truly sits within the portfolio, how quickly it can be accessed under stress, and how dependent the family is on favorable market conditions to access that liquidity. And even then, it's important to keep in mind, right? If you have a healthy amount, right, in stocks, which is generally considered liquid capital, in a period where you may want to liquidate some of that may happen to be a period that's not really conducive with the market. So when evaluating those liquidity needs, it's probably best to apply a haircut number, whether that's 10, 20, 30%, right? Because in reality, you won't be able to access that 100% of that capital if everyone else is selling at that point of time. So many portfolios look robust on paper, but far fewer may prove resilient during time of duress or in reality. And so this shift towards liquidity benchmarking reflects a broader change away from maximizing returns at all costs and more towards durability. And I'll share one more insight. There's definitely a lot more that those pieces covered, but for me, that's a big one. And I recently actually published an article on stress testing the family office, and that fifth insight for me that stood out, that very much aligns with one of the messages within my article, is that non-financial benchmarking predicts longevity. And here's the hard part, and arguably the most important: non-financial benchmarking measures intangibles that determine whether a family office actually endures. That pertains to governance quality, the human capital, next gen readiness, a culture, and decision making under stress. And so the question is not whether governance exists, because anyone can probably check the box, but how they are experienced. Offices may often assume that governance is working because they have the full infrastructure, councils and boards and mission statements and the full-blown constitution and all of that. But benchmarking frequently helps us uncover gaps between generations, branches, roles, and those gaps can become early warning signals of things to consider, think about, and address before it is too late. Human capital is a big one within that context, and probably one that is most under benchmarked, at least based on my observations and consistent with what I was reading in those two pieces that I mentioned. So families that invest early in next gen development, such as education, exposure, mentorship, readiness for ownership, tend to transition more smoothly, and those that do not often realize the cost too late. Culture is very difficult to measure, again, another qualitative measure, but not impossible to benchmark. So healthy families tend to show certain patterns like open dialogue, tolerance for disagreement, and clarity around responsibility. Conflict is inevitable, whether you're running a family or you're running a business or you're in an investment partnership, but dysfunction is not. And so, in closing, I would like to share that, at least from my perspective, financial benchmarking tells you how the portfolio is performing. Of course, that's important, but non-financial benchmarking tells you whether the people, structures, and capabilities can actually sustain that performance. And families that endure, they look at and they do both types of benchmarkings. They measure, they reflect, and then they adjust. So benchmarking is not just about keeping up with the peers, but it is about building an office that can adapt, remain coherent, and endure as complexity grows. So if this resonated with you, or please share with me one of your key takeaways in the comments below. And of course, you're welcome to connect with me here on LinkedIn or subscribe to my YouTube channel, Family Enterprise Perspectives, for future insights. And follow me to be notified of future live events. I do that once a week. Typically, it's Thursdays afternoons, but this month has been a little bit unique because I had conferences, travel, so I've had to adjust the schedule to different days of the week. But I have been able to keep up my commitment to you by showing up weekly, sharing my thoughts on the markets, passive investing, and multifamily underwriting. With that, I wish you a beautiful weekend and we'll connect next week. Ciao.